Hello, everyone. Welcome back. Today we are going to study a very important finance topic: accounting income, cash flow, and free cash flow. This topic is essential because finance is not only about whether a company reports profit. Finance is about cash, when cash comes in, when cash goes out, how risky those cash flows are, and whether they create value. A company may report accounting income and still struggle to pay bills. Another company may report low accounting income but still generate strong cash flow. That difference is not a small detail. It is one of the most important ideas in financial management. Accounting income helps us measure performance. Cash flow helps us understand financial flexibility. Cash allows a firm to pay employees, suppliers, taxes, lenders, and owners. Cash also allows a firm to invest, survive uncertainty, and grow. The central idea is simple. A business decision creates value only when the expected cash flows are worth more than the resources required to produce them, after considering timing and risk. Let's begin with the difference between accounting income and cash flow. Accounting income, also called net income or profit, is calculated using accounting rules. It appears on the income statement. It measures revenues earned during a period minus expenses incurred during that same period. Cash flow is different. Cash flow measures actual cash moving into and out of the firm. It is affected by collections from customers, payments to suppliers, wages, taxes, equipment purchases, borrowing, debt repayment, and distributions to owners. The difference exists because accounting tries to match revenues and expenses to the period when the economic activity occurs. Cash flow focuses on when cash is actually received or paid. For example, a firm may sell goods on credit in December and collect the cash in January. Revenue may be recorded in December, but cash does not arrive until January. So revenue increases, accounts receivable increases, but cash does not increase. This is why profitability and liquidity are not the same. Profitability means revenues exceed expenses under accounting rules. Liquidity means the firm has enough cash or near cash resources to meet obligations when they come due. Let's now talk about accrual accounting. Accrual accounting recognizes revenues when they are earned and expenses when they are incurred, not necessarily when cash is received or paid. This approach helps measure economic performance during a period more accurately than simply looking at cash receipts and cash payments. Two principles are especially important. First, revenue recognition means revenue is recorded when the firm has substantially completed the earnings process, even if cash is collected later. Second, expense matching means expenses are recorded in the same period as the revenues they helped generate, even if the cash payment happens earlier or later. This is useful. Borrowing $1 million from a bank increases cash, but it is not revenue. Buying equipment for $1 million uses cash, but the equipment may help generate revenue for several years. However, accrual accounting also requires judgment. Managers estimate bad debts, useful lives of assets, warranty costs, inventory write-downs, and collectability of receivables. So, when we analyze income, we should connect it to cash. Are revenues turning into collections? Are receivables or inventory growing too quickly? Are accounting estimates reasonable over time? Good analysis connects reported income to the firm's real cash-generating ability. Next, let's examine non-cash expenses. A non-cash expense reduces accounting income, but it does not require a cash payment during the period in which the expense is recorded. Common examples include depreciation, amortization, depletion, stock-based compensation, bad debt expense, and asset impairment charges. But be careful. Non-cash does not mean unimportant. A machine really does wear out. A patent really can lose usefulness. Some customers really may not pay what they owe. Non-cash expenses often reflect real economic costs, even though the cash payment may happen in another period or may not happen as a direct cash payment at all. Depreciation is a very important example. Suppose a firm buys equipment. The cash outflow happens when the equipment is purchased, but the cost is usually spread over the useful life of the equipment through depreciation expense. Depreciation affects analysis in three ways. It reduces accounting income, it does not require a current cash payment when recorded, and it can reduce taxable income, which may reduce cash taxes paid. This tax benefit is called the depreciation tax shield. So, depreciation is non-cash, but it can still affect cash flow through taxes. Let's now move to operating cash flow. Operating cash flow measures cash generated by the firm's core business activities. It focuses on cash related to selling goods or services, collecting from customers, paying suppliers, paying employees, and paying operating expenses. On the statement of cash flows, this is often called cash flow from operating activities. Under the indirect method, we usually start with net income and then adjust for non-cash expenses and changes in operating working capital accounts. A simplified formula is cash flow from operations equals net income plus non-cash expenses minus increase in operating current assets plus increase in operating current liabilities. This formula teaches us three important ideas. First, net income is the starting point, not the ending point. Second, non-cash expenses are added back because they reduced income without directly using cash during the period. Third, working capital changes adjust for cash tied up in receivables, inventory, payables, and other operating accounts. In some finance settings, we use another version. Operating cash flow equals EBIT plus depreciation and amortization minus taxes. This version focuses on operating performance before financing decisions. The main point is to understand the context and be clear about which definition is being used. Let's now focus on net working capital. Net working capital is commonly defined as current assets minus current liabilities. For operating analysis, we often use operating net working capital, which focuses on accounts receivable, inventory, and accounts payable. A simple version is operating net working capital equals accounts receivable plus inventory minus accounts payable. This matters because growth often requires cash before it produces cash. If a company sells more on credit, accounts receivable may increase. That means the firm has recorded sales, but it has not yet collected the cash. If the firm builds inventory, cash is tied up in goods that have not yet been sold. If suppliers allow delayed payment, accounts payable increases, and suppliers temporarily help finance operations. Here is the simple intuition. An increase in operating current assets usually uses cash. An increase in operating current liabilities usually provides cash. An increase in net working capital usually reduces free cash flow. A decrease in net working capital usually increases free cash flow. For example, if receivables rise by 80,000, inventory rises by 50,000, and payables rise by 30,000, the increase in operating net working capital is 100,000. That 100,000 is a use of cash. Now let's discuss capital expenditures. Capital expenditures, often called CapEx, are cash outflows used to acquire, maintain, or improve long-term assets. These assets may include equipment, buildings, vehicles, technology systems, manufacturing facilities, or major software platforms. Capital expenditures are different from normal operating expenses. Operating expenses are usually consumed during the current period. Capital expenditures create assets that are expected to provide benefits over multiple periods. The cash flow effect is immediate. The firm spends cash when it buys or builds the asset. But the accounting income effect is gradual. The cost is usually recognized over time through depreciation or amortization. This is another reason income and cash flow differ. A firm may spend a large amount of cash today on equipment, but only a portion of that cost appears as depreciation expense this year. Capital expenditures can be divided into maintenance CapEx and growth CapEx. Maintenance CapEx supports existing productive capacity. Growth CapEx is intended to expand capacity, enter new markets, improve technology, or support future sales growth. High CapEx is not automatically bad if it supports valuable growth. Low CapEx is not automatically good if the firm is underinvesting in maintenance, technology, or customer experience. Now we arrive at free cash flow. Free cash flow is the cash generated by the firm after paying for operating needs and necessary investment in long-term assets and working capital. It represents cash available to providers of capital, such as lenders and owners, after the firm has supported its operations and investments. A common simplified formula is free cash flow equals operating cash flow minus capital expenditures minus change in net working capital. Another common firm-level version is free cash flow equals EBIT times 1 minus the tax rate, plus depreciation and amortization, minus capital expenditures, minus change in net working capital. This second version is often called free cash flow to the firm. It starts with operating income after tax and excludes financing costs such as interest expense. That is important because it measures cash flow available to all capital providers before deciding how the cash is divided between lenders and owners. Free cash flow is not the same as net income. It adjusts for non-cash expenses, capital expenditures, and working capital investments. These adjustments can be large enough to make free cash flow very different from accounting profit. This is why free cash flow is so important for valuation, debt capacity, dividends, share repurchases, growth planning, financial flexibility, and performance evaluation. Let's connect net income to free cash flow step by step. We begin with net income. Then we add back depreciation and amortization because these expenses reduce net income but did not directly use cash during the period. Next, we adjust for operating net working capital. If receivables or inventory increase, cash is usually tied up in operations. If receivables or inventory decrease or payables increase, cash may be released. Then we subtract capital expenditures because long-term asset purchases require cash, even though the cost is recognized gradually over time. Finally, for firm-level free cash flow, we exclude financing cash flows. Borrowing, debt repayment, dividends, and share repurchases explain how cash is financed or distributed. They do not tell us how much cash the business generated for its capital providers. This is why cash flow analysis is not just mechanical. The same free cash flow number can mean different things in different situations. Negative free cash flow may reflect weak operations, slow collections, excess inventory, overexpansion, or liquidity pressure. But it may also reflect valuable investment for future growth. Strong free cash flow may show strength, but it may also come from underinvestment. Good analysis connects the calculation to the business story. Before we finish, let's review the most common mistakes in cash flow analysis. The first mistake is treating net income as cash flow. Net income is important, but it is based on accrual accounting. It does not show the cash available to the firm. The second mistake is assuming positive profit always means financial strength. A firm can report profit and still face cash pressure if customers pay slowly. Inventory builds up, capital expenditures are high, or debt obligations are large. The third mistake is assuming negative free cash flow is always bad. Negative free cash flow may be a warning sign, but it may also reflect investment in valuable future opportunities. The fourth mistake is ignoring working capital. Growth can consume cash through receivables and inventory, even when sales are increasing. The fifth mistake is confusing financing cash flow with operating strength. Borrowing increases cash, but it does not mean the business generated cash from operations. So, the big lesson is this. Accounting income tells us about performance, but cash flow tells us about financial flexibility and value creation. Thank you for joining me today. Keep studying, Keep connecting the numbers to the business story, and I will see you in the next video.